Hi everyone. Thank you very much for coming to the last session. I know it's been a long day. I'm going to try to keep it kind of light and entertaining and quite short because I think some of you have had enough. And quite frankly, having watched some of the presentations, I think some of my slides, you've probably seen some of the bullet points. So if you've seen some of it before, bear with me. We'll try to go through those bits quite quickly. Anyway, my name is Mark Weetman. I represent Venani. I've been asked to speak about my broker, my buddy. So literally what us as the broker should supply you with clients. So this is generally what I'm going to chat about. You know, why are you here? Hopefully after being here all day, you know why you should be here and why you should be invested in the stock market. You know, you have been told, there's two of my colleagues who have made some nice quotes, I want to quote them. Is my broker really my buddy? You know, he's on the other side of the screen. Is he really looking after my best interest? And I just want to touch on that. Then what would your expectations be from the broker? And these are really what I'd like to give you. You must take these away and compare your broker to these tests, these check boxes. So what I've included is SA's top stockbroker, the research that came out 2 weeks ago, which will tell you what sort of services your broker should be giving you, the types of brokers, costs, trading tools. We'll touch on all of these sort of things. Why are you here? Well, if you haven't guessed already, you're here to make money. The stock market is an exciting place. It's a fun place. You meet great people. But essentially, you're here to build wealth. And that's what your stockbroker should help you do. You're essentially here to build wealth. It's, in my opinion, one of the easiest forums to make wealth. I mean, you can put your money in the bank and you can get 4 or 5%, or you could make substantially more by coming into the stock market. And really, there is no barriers to entry anymore in the stock market. Anybody can own a stock. I'm sure you've been told that today. You've got to kind of get a bit of training, you've got to get a bit of education, but really, once you've learned these things, it is your road to financial freedom. You can take, you know, grasp of your own financial destiny. And it's not complicated. Trading does not need to be complicated. But the instruments themselves can be complicated, so you just need to understand them. So I want to quote two of my colleagues. Brett Duncan is actually Grant, who was on before me, his boss. So if you ever have any problems with Grant, give Brady a call. Brady's head of retail equity derivatives at Standard Bank, and Brett McLaren, who's another good friend of mine, is the CEO at Saxo Bank. These are two very good providers, but I like their quotes. They say retail brokers or retail clients, yourselves, you've got the tools at your disposal nowadays. You've got charting packages, you've got research, you've got social media. I want to come back to social media later on. You've got accessibility to huge amounts of information that you've never had before. And all of this is available to you on your iPad, your telephone, or your cell phone, or on your internet at home. So there's my two colleagues. I'm glad they endorse what I say. Everything is now available to you guys, the retail trader. I'm going to take you through then how you use some of those things a little bit later. Is my broker really my buddy? Now I think this is a question you need to ask, because he might have a conflict of interest with you, because he wants you to trade. He wants you to do volume, because that's how he makes money. And remember, the guy on the other side of the phone is essentially a psychopath. There's been research that shows that stockbrokers have a higher propensity to take on risk than psychopaths. And in fact, they've proven that these brokers have less sleep, and some of them, they've proven that guys who are partially brain dead are actually better traders. So, I mean, this is the guy who's sitting on the other side of the phone from you. So when he tells you to go into the stock, maybe question him. If he says buy AGLs, make sure that he's giving you that advice for the right reason. So just remember who's on the other side of the phone. But I firmly believe that your broker is your buddy. So I just want to, this is a bit of a punt for us. We came second in the readers survey in stockbrokers. So we came number 2. This is even a bigger punt for Sanlam iTrade, who beat us. They came number 1. But what I wanted to go through here was, what would you expect from your brokers? This is what clients rated us on, or rated the market on. So there was 26 or 27 brokers that were surveyed. Once again, I'll point out we came second. And then we were rated on service, trading platform, cost, and trading advice. So unpacking that a little bit more, what do clients expect? So cost of service. The market as a whole thinks that cost is quite fair at the moment. You know, the market is sitting between about 25, you would have probably heard numbers like 25 basis points or 0.25% and about 70 basis points. That's where the market is at the moment. If your broker is charging you more than about 75 basis points, ask why. If they're charging you 100 basis points or 1.25%, it's too much. Ask them for less. shouldn't be paying that sort of much, unless they're adding a huge amount of value. But you can see the market as a whole thinks that brokerage rates are quite reasonable. Common instruments, most people trade equities. I mean, that's why you're here. You came to learn about shares. But don't lose out on these other things. I'm sure you've heard Mike Brown talk about ETFs today. Very good instrument. 20% of clients on the exchange trade those, and then about 10% roughly trade the other instruments. Have a look at these other instruments. There's certainly very good products on the JSE, and I want to touch on that again just now. Quality of service. Surprisingly, the clients are happy. Most respondents rated brokers as being good or excellent. So that means you should all be getting good service. If you're not, change brokers, because there's some good guys out there. Number of trades per month. Now this one for me is quite a disappointing slide. Most clients do less than one trade a month. So you get all this technology, you get an online trading platform, you get research, newsletters, etc., and you do less than one trade. That's really, you've got all these wonderful things at your disposal, and you're not really doing anything with it. So the vast majority of clients sit in the 1 to 3 trades. Our average client on our active trading side does somewhere between maybe 12 and 15 trades a month. So I don't know why people are not using their platforms more. Quality of trading platform. One good thing is that excellent and good for trading platforms. Stockbrokers as a whole in this country have very good trading platforms. So you must make use of them. So whether that's on the iPad or whether that's on your desktop or your laptop, there's a tendency for very good trading platforms. Okay, so that is the summary of the research that was done by Business Day on the top brokers. And you can see that brokers are actually providing quite good service at good rates with good platforms. So as I say, if your broker's not giving you that, then move. So, okay, my next slide is all brokers are not made equal. Historically in the markets, brokers have been segmented into 2 camps. There's the traditional broker. He supposedly gives you full service. He gives you research, he analyzes your portfolio, he has one-on-one discussions with you on the telephone, and you pay him more money for that. On the other side is this crowd called the discount brokers or the online brokers, and there they don't want to talk to you, you execute online, they send you research electronically, and they don't talk to you, and supposedly that you get lower commissions. Well, in my opinion, the market is not that simple. We see convergence between those two. We think your stockbroker should be providing you traditional full-service brokering, so that's the ability to phone him, the ability to get his research, you get advice from him, but at discount broker rates. And that's where we think the market is at in our country at the moment. You should be getting a mix of those two from your broker. Now, I just want to go on talk about cost a little bit, because cost, everybody hates to pay for things. Everybody wants things for free, but that's where your broker makes his money. So typically there's 2 types of models. That's the only place he should be making his money. There's 2 types of models in our country. One is a sliding scale, so which says the smaller your trade, the more you should pay, or a flat model. Now we employ a flat model because we think it's unfortunate that the guy who trades small should be charged the highest rate. Because typically he's entry level and he's being charged 1.5%, maybe 1.2%, and we don't think that's the way things should be done. So our brokerage is not the cheapest. We're at 0.5%. As I say, in our opinion, the market is between 0.25% and 0.7%. But brokerage is not everything. It's all these other fees. So when you do an equity trade, you're going to pay straight. Minimum $10. You're going to pay insider protection levy, which is not a bad thing because you're contributing to a fund that if there's a failure, you supposedly can claim on that fund. And you pay securities transfer tax at 25 basis points on the buy. So in some cases, that's almost as much brokerage as you paid on the on the buy side. And then of course you pay VAT. The other thing about fees is, as I said, sliding scale versus flat fees, we dislike a sliding scale. We think that everybody should be treated equally, and that clients who do big trades, well, they can come and negotiate a trade, but a price, but off that lower rate already. Also, it used to be that online deals used to be cheaper than traditional deals. We don't think that's the case. Why should you, if you phone a broker versus going online, should you pay a different price? So what we've seen is that the price for both of those types of trades have come down. Also remember, people forget that you buy and you sell. Once you've bought something, you have to sell it. You're going to pay brokerage on both sides. So, when you buy the trade, also budget in that there's going to be cost when you sell it. Beware of any hidden fees. If you don't trade, they may charge you for data, for platform, etc. Just make sure that you know about these fees, so you don't get a surprise at the end of the month when someone does a journal to your account and takes that off. Watch out for exit fees. If you're not happy with your broker and you want to leave, it's fine. There's a cost of transferring that script to another broker, but it shouldn't be exorbitant. It shouldn't be used as a stick to keep you, or a barrier to keep you at that broker. So be careful of these exit fees. This one's called Mind the Gap, and it's although I like small cap stocks, they can be expensive. And the reason they can be expensive is because if your share is trading at 9 cents, well, 10 cents offered and 9 cents bid, you buy it at 10 and you sell it at 9, you've lost 10%. And that is the difference between the bid-offer spread of small caps. It's implicitly part of that market. If you get towards a large cap share, your bid-offer spread on AGLs goes down to sort of 0.1% is the difference between the buy and the sell. If you have a trading platform that has AGLs at a wider spread than that, then your broker is doing something to the price. Just keep an eye on these spreads. AGL 0.1%, ABSA 0.18%, should be your typical bid-offer spread on those sort of liquid large counters. This is to do with sliding scale, so I'm not going to carry on about that. What do you want to invest in? Well, everybody's talked about equities today, hopefully for you. They might have talked about commodities, exchange-traded funds. All of these things are on the exchange. The exchange has a huge amount of instruments with the broker that you can trade. So whether you want to trade Forex, whether you want to trade commodities, bonds, etc., all on the exchange. So once you get sophisticated and you want to just move out of this little bucket called equities, you've got all these other things here. IDX, for example, you can trade Facebook shares on the JSE. They have the international derivative listed on Facebook that you can trade. So once you get a little bit better at this, have a look at these instruments that your broker should be offering you. Understanding that with return comes risk. So the more return you want in life, the higher level of risk you must take on. So if you are trading an index future that is 18 times geared, you're going to make a lot of money or you could potentially lose a lot of money. So with return comes risk. Just to kind of give you a flavor for what we think a broker should offer you, these are a couple of slides by my head of trading, Jaco, and he calls it his EAT. Evaluate, act, track your progress, and track your end goal. This is literally taking you through some slides from our trading platform to show you what you should be getting from your broker. So, on the evaluate, what you want is research. You want to be able to see pricing and do some charts. So, typically, most trading platforms should have these sort of things: top 40, resources, industrials. Should be able to show you up by top 10, up by percent, top 10, down by percent, the usual stuff. All of this should be available on a typical trading platform. You then should be able to get some international indicators. Dow Jones is the most watched index in the market, so you should be able to see what the US is doing. Rand dollar is important for resource counters, the gold price. All of these things you should be able to take cognizance of. You cannot trade a resource share without knowing where the Rand dollar exchange rate is and where the gold price is, in my opinion. How can you trade a gold stock if you don't have those two prices? They're implicitly part of my share price. So those sort of things you should be watching. You should also have charting. All trading platforms now should have, this is an intraday chart with a little Bollinger going there, some candlesticks. All your trading platforms should have basic charting like this and should have end of day charting. You should be able to see news announcements, sense announcements coming out. Sense announcements are important. If someone comes out just saying that they're expecting total earnings to be down 20 or 30%, it will have an effect on the share. And then you should expect your broker to come give you morning reports, economic research, stock picks. And I want to come back to Twitter because, as I said, I think social networking is changing the way we trade. So I'm going to come back to that Twitter. Once again, basic market overview sort of stuff. Buy, hold, sell, research. That's the sort of stuff that you should expect nowadays as almost part and parcel of your relationship with your broker. And if you're not getting that, you should ask why not. Then once you've got all of that, you need to make a buy or sell. So I've just put up a buy and a sell there for a share. That then goes, of course, into your portfolio. So there's your order book, but I want to show you this one. What our market is becoming is this. There's a single stock future on Anglo-American. You've then got the Aussie. This client's bought a derivative, an index future, some Nokia, IDX, a Rand dollar contract, and possibly some shares. There's Apple, and all of those things are on our market. So that's the sort of stuff that this is a client's order book with us. All of those sort of things you can trade on our exchange. You don't need to go anywhere else in the world to trade these things. So that's commodities, currencies, foreign shares, and equities all in one book, in one trading book. Okay, so that is what a typical trading platform should look like from your provider nowadays. So now I'm going to go into trading strategies, and this is just one thing that and I must say, caveat emptor on this, I'm a very aggressive trader. I like short term, I like gearing, I like to be in and out of a trade very quickly, and this is my trading type strategy. So I've given you this as my recipe, take it away and tweak it, but I call this my no guts, no glory. Sir Francis Drake was supposedly his quote, and if you look at my anagram, it says guts, and this one says real. So I call this my real guts trading strategy. So what am I looking for? I want to trade short term. I get very bored if a stock doesn't do something very quickly. So I want to be in the share between 2 days and 6 weeks. I do money technicals, and that's because I'm lazy. Reading a balance sheet is hard work, and an income statement. It's damn hard work. Unless one of my analysts is going to summarize it for me, I'm probably not going to bother. So I'm very much technical in nature. I look for shares that move 3 to 5%. I'm not particularly greedy. If I can get more than that, that's great. How do I make money on 3 to 5%? Well, I use the geared instruments on the exchange to try and get 30 to 60% performance in my portfolio on those trades. This one's important for me. How much am I willing to make and how much am I willing to lose? Our market is very much about money management and stop losses. You know, it's easy to pick stocks, but where do you want to get in? Where do you want to get out? Are you going to make a profit? How much profit are you going to make? Always try and make 2 Rand profit for every 1 Rand you're willing to lose. Yeah, so when you look at your chart, you say, I'm getting in here, I'm going to get out there, I'm going to make 2 to 1. If you're going to make 1 Rand for every $2 you're going to lose, you aren't going to be in the market very long. You're going to be out of business. The other thing is always have an exit plan. And I said this morning in the other presentation, when I get on a plane, I typically want to be 8 rows from the door. Because statistically, those are the people that survive in a train crash. I mean, a plane crash. Probably in a train crash as well, but it's probably only 3 rows in a train crash. But in a plane crash, you have to be within 8 rows of the door. If you're on row 9, 10, and 11, was I that long that you shut me off already? You're going to survive. Statistically, you're going to survive. I treat my trading like that. When I look at a trade, I want to know where I'm going to get in and where I'm going to get out. Where is my exit? And my exit is either with a profit because it's hit target, or I've stopped out. And there's no embarrassment about making a loss. We're all going to make losses in the market. So always have that stop loss. And I call it my exit strategy, or knowing where the fire escape is. So the fire escape is over there and maybe over there. So the guys in the middle are stuffed when there's a fire, but the rest of you are okay. That's what I call my exit strategy. Okay. We sometimes use trailing stops, and for people who don't know what a trailing stop is, it just means that you move your stop loss as the share moves. So if the share keeps making you money, stay with it. But as soon as it comes back down and hits your trailing stop, get out. And the last thing is, I've been burnt over the years with illiquid stocks. Because you can get in, you can make a profit, but when you want to get out, you can't get out. Everyone rushes for the door at the same time, and the share plummets. We tend to stay in liquid stocks. That's the sort of top 60, 80 stocks on the exchange. So this is my sort of no guts, no glory, or my real guts trading strategy. Take it away, have a look at it. I mean, that's the sort of thing that you'd expect from us if we started sending you trading ideas. So this is a typical trading idea from us. This was a stock pick on Standard Bank. We're buying it. And you know, I'm a great fan of Groupon. I mean, does everyone get Groupon coupons? Well, so that's what our stock pick looks like. It looks like a Groupon coupon. We want you to know it's a buy. We'll tell you if it's a sell. This one's a buy. And we're going to tell you then where to buy it. So you're going long at a certain price. We expect to be in the trade 7 to 10 days, blah, blah, blah. Anybody, send me an email. You can have this research from us. We send out typically 1 or 2 of these every day, these trading ideas. That's what you should expect from your broker, that he gives you actionable trading ideas every day. What he should also do is tell you how to spend your money. So if you've got a diversified portfolio and you say, and I've had a couple of guys come to me at the table say, what should I do with this cash? I've got this bucket of cash and I don't know where to start. Well, typically the market is made up of all these different buckets. So you've got resources, industrials, financials, telecommunication stocks, and it has a weighting. And then we have a model portfolio which says, well, we want 32% of our money in resources, and we particularly like those counters. And we want some industrials, and we like that counter. And that gives you an idea where we're spending our money. So if you want to go and then take this and implement it yourself, you're more than welcome. You can go and buy those stocks in those percentages and put them, and you'll have a very nice diversified portfolio. So that asset allocation strategy is available for us. This is our growth fund. So if you wanted, you could mirror our growth fund. The other thing is we have people like Viv, who hopefully, Viv and Kuzi and my other traders, who go on TV and they send out morning notes, etc., and they should be telling you what to do. The other thing, as I said, social networking for me has changed the way we do business. So Anthony Clark, who works for us at Vunani, is the top-rated #1 analyst, small cap analyst in South Africa at this moment. And he tweets. Every day he tweets. So he makes available to you, for free, his thoughts and his ideas. So you can see in here, he's talked about Ellie's, Kelly, NWL. So where life has changed is he would have gone and seen one of those companies, he would have gone back to his office, he would have written a research note, and he might have sent it out a couple of days later. Now what happens is he leaves that meeting with his iPad and he tweets immediately about that meeting. And it goes into the public domain. You get it at the same time as everybody else. And he tells you whether he likes Cura or doesn't like Cura. So typically we also do that. We put out our stuff. So anybody with Twitter on a phone can now get the top-rated #1 analyst in South Africa's tweets immediately. And that for me changes the landscape in stockbroking. Okay, so just to, that takes you through some of what I think your buddy, your broker should be doing for you. And once again, I'm going to reiterate, if your broker's not doing for them, get divorced. Leave them. Find another broker. So I just want to leave you on a couple of slides, which is about what type of investor are you, because that'll guide you to what sort of trading you should be doing. Are you active or passive? If you're passive, Michael Brown's ETFs are a wonderful product. Well, it's not his product, but his website has got the ETFs on it. But ETF's a great product. What is your time frame? How long do you want to be in that trade? How much do you want to spend on that trade? How active do you want to be? Are you a guy like me who will trade? If I could trade 100 times in an afternoon, I will. But other people might not trade 100 times in a lifetime. So what is your time frame? When do you need the money? If you have school fees to pay in 2 months from now, you cannot buy a share that you think you're going to be in for 3 years. It's just pointless. You're not matching your investment time frame to your cash flows. What is your risk tolerance? Now, clearly, I said to you earlier, our stockbrokers are ranked on par with psychopaths. So we have a high level of risk tolerance. We like taking on risk. You might not like risk. You might want to go and buy nice, stable, dividend-producing blue cap shares. Match the trades to that risk profile. And then, why are you trading? If you're trading because it's very nice to go to the braai, or down the road to the pub and tell them that you've got SA breweries in your portfolio, well, that's not good enough. It's about results. Stockbroking is fun. We have a good time, it's exciting, but it's all about the money. If you are not trading to make money, then I think, do something else. It's about results. And if you're not making money, then change your strategy. Some of the trading pitfalls that I've noticed over the years, and I've been doing this quite a long time. As I said in this morning's presentation, when I started as a broker, I had lots of hair. And I don't have any left now. So you can see I've been doing this quite a while. Not having an exit plan. Know where the fire escape is. Portfolio balances. We see this very often with new clients. They take all of their money and they put it into one share. It's their first trade. They shove it all in there. They get it wrong. They pick the wrong stock. And a month later, they have no money left. And it'll happen. It will happen. You pick a penny stock that's trading at 10 cents, you put all your money in it, you know nothing about it, and it goes to zero. That's you done. Failing to cut your losses. If you are losing money and the stock is wrong, get out. As I say, find the fire exit. Get out of the trade. The flip side of it, and we all do this, we're all anxious to make profits. So we sell much too soon. Keep those winners sometimes. There's an old saying in the trading market which says, you water the weeds and you cut the flowers. And that's typically what we do. We keep all the rubbish stocks and we get rid of all the good ones. Sometimes stay with the winning share and stay with it until it stops winning for you and then get out. So selling too soon is a pitfall. Buying shares that continue to fall. I've heard averaging down. Everyone talks about averaging down. Don't average down. Because what will happen, and a good example is the Dimension Data at one stage went above, I think, 80 Rand at one stage, and then fell all the way down to 2 Rand 80. If you carried on buying it all the way down, your portfolio would have been dead. Yeah. So you cannot, if a stock is falling, don't average down. Don't confuse that, however, with a good trading strategy is when you buy, don't buy all of it at once. Because the stock might get a little bit cheaper and you might buy your second tranche. That's not averaging down. That's just how you're getting into the stock. Don't add losing shares to your portfolio. How many times have some of you done this, and I've done it as well. You get rid of the good stocks, and you keep the bad ones, you put them in the bottom drawer and you forget about it. And you just end up with a bottom drawer full of junk. And then the other thing is emotionally attached to a share. Just because you loved it, and you don't fall in love with it. I mean, it's just, you get so caught up with that share, and you keep saying it's going to come right. It's just better to cut it and run. So those are some of the things that, people get divorced, average 3 times. I mean, but they get stuck with a share. I don't know, it just doesn't make sense to me. So. And then, I'm going to leave you with this last one, and this is, my son has just joined Scouts about three weeks ago. And, they've got all these, hand signals and whatever. It's like, it's like a mystery society to me. But anyway, so, but I want to leave you with this. It's just what I call the trader's creed or the trader's promise. We as a broker give you a platform. We give you advice, we give you research, we give you everything you need. But at the end of the day, it's all about you. You need to take responsibility. It's all about your trade, your actions. You're responsible for your actions, your trade, doing some research. Be a part of the process. Don't just be spoon-fed. Be a part of the process. And then you'll be successful. If you just sit back and you get a trading platform and you throw your money in there and you don't do any training, no research whatsoever, you are guaranteed to lose money. And I know that's not a stockbroker's job to tell you that. His job is to tell you how much money you will make. But you will lose all your money, guys. So I'm just saying I like successful clients because they will stay with us forever and they'll make me brokerage forever. But if they lose money, all their money next month, there's no repeat business for us. So, guys, buy into this. Take control. And I think that's about it. I think I've got time for a few questions. Fire away, guys.
I've just got a question. You mentioned that the ETFs, you saw them as quite passive and they take time versus your strategy of, the more you put in, the more you get out, basically. But for the average person, would the ETFs not be better? Because I don't think if you're an average person, you'd want to risk so much in case of a market crashing or a war starting or...
Okay, so if a market crashed,
or something like that.
Okay, let's take your example. I like ETFs. So if I gave the perception I don't like ETFs, I think there's a place for every one of those instruments in a person's portfolio. I'm just saying that my trading style, I'm very active. Let's face it, if you're in an ETF and the market crashes 15%, you will lose 15%. You will just have to ride that out. Because you're in a passive product which will follow the market down. So it is what it is. It'll track the market. If you're an active manager like me, maybe you could go short and make 15%. But that takes a certain type of activity and mindset. So there's nothing wrong with ETFs. Nothing wrong with active trading.
Buy more money though.
No. In fact, we've got derivative traders with 5 grand in their account. So it's horses for courses. As I said, there's this whole bucket of instruments. Find something that works for you. I spoke to a lady at lunchtime. She trades Forex. Now, I don't trade Forex. Forex is 100 times geared. It's very active. Things move exceptionally fast. Then if you've watched the dollar-euro, it is an exceptionally difficult instrument to trade. Now, she does it successfully. So she's clearly got more time than me, or she's more active than I am, and it works for her. It's not going to work for everybody. So find one of those instruments that works for you. We've got traders in our trading environment that only trade index futures. They trade Aussies. They've become some of the best traders in the market at trading Aussie. All they do. So find what works for you. If buying the ETF and holding it for 3 years makes you money, happy with it. Do you know what I mean? Find what works for you. Okay, that's why I said my recipe is my recipe. It's like watching one of those cooking shows and they say we've got eggs and milk and this and that and I make this out of it. But you could make something completely different. Okay, so find something that works for you. Okay. There's no wrong answer in this market. There's just you must make money. That's the right answer in this market for me. If what you're doing doesn't make money, then it's not the right answer. I know this is going to be a difficult one.
Okay, let's take a company, and the company's made a loss.
Yeah.
What really confuses me is then the PE ratio, or actually what they start making. So let's say the first year they make 50% loss, and then the next year they start making a profit. What is happening with the price earnings ratio?
Well, I mean, the definition of price earnings ratios is the relative price to earnings. And if you haven't got earnings, then the ratio is meaningless on a minus earnings. So I think you'll find if you put that into a spreadsheet, it'll give you a divide by 0 or something. But the next year you'll get a PE ratio. So I'm not sure the question on a minus earnings company, for me, PE ratios become irrelevant because you cannot analyze, you can hold that stock indefinitely forever, you will never make your money back. Because that's the definition of a price earnings ratio, is how long must you hold that stock to get earnings to compensate you for the price you paid. And if it's negative earnings, you will never be compensated. So unless something extraordinary happens to that stock, I think PE is irrelevant. The next year, when it comes back into positive earnings, then you can measure it and then you can use something like PE ratio. So I'm not sure of the question, but yeah, look. The essence of PE ratios, I mean, it's to tell you how long you must hold that stock so that those earnings pay you back the amount that you paid for the price, for the share. So if you've got negative earnings, then theoretically it will never pay you back. But there are stocks in the US that seem to trade at fantastic prices that have no earnings. So, IT listings, social networking companies that have no earnings, but they trade at massive prices. You'll never get your money back there, theoretically. So, there's a philosophy in the market which says there's a bigger sucker rule. So that one is you clearly buy it and you must sell it to a bigger idiot out there who thinks it's going to go up. Because fundamentally you cannot analyze that stock. I don't think I answered your question very well, but yeah.
So just like a quick question, do you maybe know how many people are trading in the JSE at the moment, approximately?
That's a very good question, and it's going to be a big, big guess. And I would say it's somewhere between, and the JSE is probably better to answer this, it's going to be between 200,000 and 300,000 accounts that are open. How many of those are active? There's probably more than that now. How many of those are active? Oof, I think you'd probably find 10 to 20% of those accounts are active. So what does that leave you in terms of numbers? That's probably 30 to 60,000 active accounts. I don't know. Standard Bank alone, I think, would have 30,000 accounts, active accounts. So that's the sort of quantum. So relative to a population of 40, 50 million, it's poor. The penetration is rubbish. If you went and looked at the Australian model, they would probably have 3 to 4 times the number of accounts that we have. They have much more penetration that their population opens a stockbroking account. So our market should be, in terms of number of accounts, probably 3 to 4 times bigger than it is. So, does that answer it?
Yeah.
Okay. That stat, though, should be readily available from the exchange, I would hope. Anything else? Thank you. I was going to say, thanks. I can get out from underneath these lights. I'm cooking, but carry on. Last one then.
Anyway, it's just been burning me concerning the position of a broker with the provision of all these online technologies.
Yes.
Will I still need a broker in the near future with the tweeting and the apps and all this? Should I?
Yeah. You know what? Theoretically, you can buy a car on the internet. You can design it. You can have it painted a certain color and upholstery, etc. But you still want to walk in there every now and then and sit inside it in the showroom and chat to a guy. You might not buy it from him, but you still go in there and kick the tires. And I think that's not a bad analogy for stockbroking. So 10 years ago, I would have probably had 20, 30 traders on the desk, on equity traders. I've probably got 4 or 5 now. And that's because a lot of clients do it themselves online. So the value that that broker must now give you is research, trading ideas, be able to answer your problems when you phone in, etc. So he's a different animal to 10 years ago, where he would have just been a switchboard operator. He would have just answered the phone and said, how is it? Yes, you want to trade, put it in. He must now add value in your life. Otherwise, just do it yourself online. So I think it's like the car dealer. You know, you're still going and, you know, you could buy food from Pick and Pay online, but you still go in there and sniff the oranges and steal a grape or two. You know, you still go in there. Yeah. Anybody else? Come on, you've got free broker time here. Come on, far away.
Is there any comparison with this, between this and gambling?
Yeah,
Casino business.
I was actually, do you know what? And I'm not going to drop names now, but I'm going to drop names. So I had drinks 2 weeks ago with Rassie Rasmus from Old Cheetahs, which I hope you know who he is. And he plays blackjack. And he said to me, the stock market's like gambling, he doesn't trade. And I said, no, gambling's like gambling. Because when you gamble, you know, red or black is a 50-50 bet. Okay. And it's in fact not even a 50-50 bet, because the house has 0 and 0-0 on some tables. So he has 2 extra on his side against you. So it's probably 48% yours, 52% the house. But people go there and they play roulette. The stock market with a good broker, a good analyst, should get between maybe 60 and 70% of his calls right. So in my opinion, that gives you the edge. So whereas at the roulette table it's a 50-50 bet, your research analyst should be 60 to 70% right. However, that being said, if your research analyst says he's 100% right, he's running a Ponzi scheme. There is nobody in this market that can be 100% right. Even 80, 90% right doesn't sound right to me. 60% though, if you've got a guy who's making you 60%, he's coming up with all these stock picks and they're 60% right, and he makes you 2 rand for every 1 rand, if he does proper management, you're going to make money. And that, in my opinion, is why it's not gambling. Because it's slightly in your favor. You know, and there shouldn't be someone on the other side of that equation who's just skimming out of the equation. So hopefully I've answered your question. I don't think it's gambling.
Okay, so you're buying and trading a lot?
Oh, there again. Yeah.
So you're buying and trading a lot. So each and every time that you buy and sell, you have a fee, let's
Yes.
say 0.9%. So you should have some information in that case that in 2 weeks' time you've made more than 1%.
That's right. Yeah, if you are doing lots of stock picks, and all those stock picks are not, so let's say you're trading every day, and you're making 1% and your brokerage is 2%, you'd be crazy to continue that equation. So what should be happening is, if you're going to trade actively like that, first of all, you go and negotiate with your broker to get the best rate you can. Secondly, if you're going to trade intraday, you phone him on the sell leg and you say, hi, I want you to zero that sell leg because I'm such a good client of yours. I bought this morning and I sold in the afternoon. And he might actually do that for you if he's looking after your business. So that gets rid of one of the brokerage legs for you if you're very active. But yes, a stock pick, if you put a stock pick out like that Standard Bank one and you say we must make 3 to 4%, that's got to take into account that it cost you 50 basis points to get in, 50 basis points to get out. And so your net profit must be net of that. You must make money after those costs. If over 20 trades, all that's happened is you've paid a lot of brokerage, then clearly that's just there to churn and make the broker money and not you money. Okay. Look, we like activity. 1 trade a month out of clients doesn't make us any money. So we want activity, you know, but it must come with you making profit. Okay, it's a quid pro quo.
Okay, afternoon, this end. I don't know if I'm following correctly, but if my understanding is that if you're starting off as a passive trader, then it's probably more recommendable for you to go on an online platform and do it on your own. And you've also mentioned that the broker's possible point of value in the transaction is probably on an advisory level. You would be able to pick up the phone and say, should I, shouldn't I? Do you then charge as a broker for, is there a breakdown of what you would charge for, or is it just like a flat rate? If you've only just advised me, or if I phoned you and said, I'm thinking of doing this, should I, what do you think?
Yeah, I think when you sign your original mandate, so let's differentiate. So if you go to ETF SA and you buy exchange traded funds on Mike's platform, clearly there's no broker involved there. You're going onto a web-based platform and there's some sort of fee. I'm not sure what Mike's fee is. If, however, you come to a stockbroker, when you first sign that mandate, make sure of what you're signing. Look at the fee schedule. And if there's a little item in there that says advisory fee, if you're going to just do online trading, and you know that's all you're going to do, you don't want advice, you don't want someone to phone you, etc., and they're charging you an advisory fee, put a line through it. Because why pay for something that you're not getting value? So if that broker is charging you 1% per year for advisory fees, and they add no value whatsoever, just cross it out. An initial next to it, take it out of the fee schedule. You know, only pay that if you think that broker is going to give you value. Now, for the record, we don't charge an advice fee, even though we give advice. We make only brokerage. So you will see in the fee schedule a brokerage fee, and that's all we get. If you trade online, that's your choice. If you want to phone through the desk, that's your choice. We don't differentiate. We still charge a lower brokerage rate on the both. We don't charge an advisory fee. I don't like it. I don't think it's necessary. Sorry, there was one other thing I wanted to say there. Yes, Helen, who is at our desk, some of you might have met Helen. Even if you're trading online, what you should still expect is that someone teaches you how to trade online. So there should be at least a seminar that you go to, or some online training or something. You know, whether it's on a weekend or on a Thursday night or whatever, or in their offices, you should at least still get some training, because just giving you the online platform is not good enough. Okay. So you might guess, I'm very passionate about this. I think even for online trading, you should still get service. Yo.
Like, if I'm going to start trading and I have to compare brokers, which one will give me a better advice and which one will be good for me? How do I get that information?
Yeah, I don't know of a website that does a comparative of brokers, but the best way to do is just go into each of those brokers' sites, maybe download their fees, have a look at what functionality you get, what you're paying for their trading platforms. Are they going to charge you for data? Are they going to charge you for seminars? Whatever. And then you might have to put a matrix together. You know, I don't know. Take your time. You know, you don't have to rush into this relationship. You don't get married in a hurry. You know, just take your time on this thing. Just go to each broker's site, download their mandate, look at their fee schedule. Because what is on their website might not necessarily match the mandate that you're signing. So just look at the fee schedule.
Okay.
They're obliged. The market is very transparent. They have to tell you their fees. Okay, should we call it on that? Is there anything else? Okay. Thank you very much, everyone.